Let's talk about investing. If you've ever looked at the stock market and just felt completely lost, you are not alone. So today, we're going to demystify the whole thing and give you a simple, clear map to get started.
So here's our game plan. We're going to start with that big dilemma every new investor faces. Then we'll cover the one simple rule that solves it. After that, we'll look at the actual ingredients of a solid portfolio and build out a simple 3-layer plan. And finally, we'll talk about the traps you need to sidestep and show you how starting small can lead to winning big.
All right, so let's dive right in with a feeling I bet is pretty familiar to a lot of you, the investor's dilemma.
Right? It's just a lot. You open up a brokerage app and there are thousands of stocks, funds, and all these different options. It's so easy to just feel paralyzed. But here's the thing. That feeling is totally normal, but it often leads to one huge mistake.
And this is it right here. Beginners tend to do one of two things. Either they hear a hot tip from a friend, get excited, and throw all their money into one single thing, or they get so afraid of making the wrong choice that they just do nothing at all. Both of these can be pretty disastrous for your wallet. But don't worry, there's a simple antidote.
So what is that antidote? Well, it's a really simple idea we're going to cover now called the one basket rule. And honestly, this one concept is the key to getting past that fear and uncertainty.
I know. You've heard this 1,000 times, right? But in the world of finance, this is not just some cliche. It is literally the single most important rule for building wealth safely. This one idea is the bedrock of a smart investment strategy.
The fancy word for this rule, it's diversification. And that's all it means. You're just spreading your money around so that if one of your investments takes a hit, it doesn't sink your entire ship. Think of it as your financial seatbelt.
Okay, let's make this real. Imagine two investors. The investor on the left has portfolio A. They've put 100% of their savings into one hot tech stock. The investor on the right has portfolio B. That same amount of money is spread out across a bunch of different things. So, what happens if that one tech company has a really, really bad year?
Boom. For portfolio A, that is absolutely devastating. Over half your money, just gone. But in portfolio B, yeah, the tech part of it goes down, sure, but your other investments in things like healthcare or real estate might be doing just fine or even be up. It cushions the blow. You don't panic. You get to stay in the game. That is the power of diversification.
So if we're not putting all our money in one place, where does it go? Let's talk about the main ingredients you can actually use to build your portfolio.
There are really 5 main categories, or what people call asset classes. First, you have stocks. Think of these as the engine of your portfolio. They have high potential for growth, but also higher risk. Then you have bonds. They're your cushion, safer, and they help stabilize things. With real estate, you can use things called REITs to earn rental income without actually having to be a landlord, which is pretty cool. Commodities like gold can act as an insurance policy. And finally, you've got cash. It's your safety net. It won't grow much, but it's safe and it's there when you need it.
Okay, so now we know the ingredients. The next big question is, how do we put them all together into a recipe for success? Well, that brings us to a super simple, actionable plan.
Let me introduce you to the 3-layer portfolio. It's super straightforward. The biggest chunk of your money, about 60 to 70%, goes into what we'll call your foundation. Then the next 20 to 30% becomes your stabilizer. And finally, a small slice, just 5 to 10%, can be your booster.
And here's how simple this can be. For that big foundation layer, you could use just one thing, like a broad market index fund. An S&P 500 ETF, for example, gives you a tiny piece of 500 different companies with a single purchase. Boom, instant diversification. For your stabilizer, you add things like bond funds or international stocks just to smooth out the ride. And for that little booster layer, you can add a little spice, maybe some real estate or gold for that extra growth potential.
Now, once you have a plan, it's just as important to know what not to do. So let's quickly cover 4 really common traps that can completely derail even the best intentions.
First up is fake diversification. Look, owning 10 different tech stocks is not diversified. That's just a concentrated bet on tech. Second, you can actually overdo it. Owning 50 different little things can water down your returns so much that you barely see any growth. Third, don't ignore the rest of the world. Adding some international investments protects you if your home country's market has a rough patch. And finally, the 4th trap, just setting up your portfolio and then completely forgetting about it. And here's the fix for that last one. It's called rebalancing, and it's so simple. Let's say your stocks had an amazing year and now they make up way more of your portfolio than you originally planned. All you do is Once a year, you sell just a little bit of what grew and use that money to buy a bit of what didn't. That's it. It just brings you back to your original percentages and keeps your risk level in check.
All right, we're in the home stretch. We have to tackle the biggest myth of all. This idea that you need to be rich to even get started with investing.
Nope, that is not a typo. Seriously, thanks to something called fractional shares, you can now buy a piece of even the most expensive stocks or funds for as little as $10. The amount you start with matters so much less than the simple habit of just starting.
And this really gets to the heart of it. Don't wait for the perfect time to invest. Don't wait until you think you have enough money. The real key to building wealth is consistency. It's getting your money working for you as soon as you possibly can.
I'm serious, this is it. No matter how old you are, the time you have in front of you is your most powerful asset. Every single day you wait on the sidelines is a day of compound growth that you can never get back. The sooner you start, the less heavy lifting your money has to do down the road.
So, I'll leave you with this one question. After everything we've just talked about, what is the one single thing that's still standing in your way? Is it still fear? Is it a little bit of confusion? Is it just taking that very first step? Whatever it is, my goal today was to show you that this is so much simpler than it seems. You have the map. Now it's time to start the journey.